Hello all, it's me again for the 8th PowerPoint in our narrated PowerPoint series for CC4, Production Cost and Revenue, and today we're going to start to look at profit. Obviously we've looked at marginal cost, marginal revenue, profit maximisation, a whole range of other things. And what we're going to do today is to look more specifically at profit. So the things that you're going to need to cover in terms of the specification are listed below, as you'll see, and we are working from page 53 in your yellow booklet, your course companion 4. Okay, so first things first then. This is 4.1.4.7 as part of the specification, and basically it's about the profit that businesses are trying to make, and basically that is the difference between total revenue and total cost. What are you going to need to know about these particular areas? Well, let's take a look then. The content you're going to need to know. First and foremost, what the profit is exactly like we just described. It's the difference between total revenue and total cost. And we also need to be able to differentiate between what are normal and abnormal or supernormal profits. Now, I think I've mentioned this a couple of times before, but normal profits and the definition of normal profits and abnormal profits are a bit weird in terms of if you're looking at it from a business standpoint, profit is where you actually have made a profit, i.e. total costs are less than total revenue. When we're talking about normal profit in economic terms, that is essentially the point at which profits actually equal your total cost plus any opportunity cost. So it's a bit of an odd way of defining it, but you need to be aware of it and be able to explain it, and we'll look at that in a bit more detail shortly. We're going to look at the role of profit in a market economy. What is the role? Why is profit important? How is it used as a motivator, etc.? And why is it? What role does it perform within a market economy? And the general thought, the general assumption, as far as economists are concerned, is that most firms have a single business objective of profit maximisation. So that is basically where total revenue is exceeded by the most it can total cost. And so in essence, what we're looking at in this position is if a business is trying to profit maximise, that means they're producing a level of output at which profit, which is basically, as we mentioned, revenue minus cost, is at its greatest. And we'll look at that in a little bit more detail in a moment. So let's take a look. So in terms of the page 53, which talks about the content that you'll need to know, there is an explanation of what normal and supernormal profit is. So have a read of that paragraph in the box, which just gives a definition of normal profit, which is the minimum profit that a firm needs to make to stay in business, whilst being insufficient to attract new firms into the market. So effectively what we're saying is that it's total cost plus the opportunity cost. And we'll look at the difference between the way in which an accountant might define profit and the way in which an economist might define profit, because that sort of explains it reasonably clearly. Okay. Again, take a look at the information which tells you a little bit more about how economists treat normal profit. That's cost of production. And so total cost, any cost paid out are referred to as financial cost. But when we're talking about a normal profit for as far as economists are concerned, it's essentially the same as break even, or sometimes known as break even, where normal profit is only earned where total revenue equals total cost. Okay, so that's quite an important principle to understand. Okay. So when we're looking at that, clearly we're assuming that we're in a profit maximisation mode. So the businesses are attempting to achieve as much profit as possible. Now, we've got a situation as well where normal profits would be the amount that you that keep firms in a particular business or market, and that essentially is where total cost equal total revenue. But you can have a situation where if you're in a profit maximisation mode or your objective, and you actually are able to somehow influence the market in some way, so be a price maker rather than a price taker. In those situations, if you've got some market power, you might well be able to achieve supernormal profits, where effectively the total revenue that you're achieving is significantly higher than your total cost, and in that situation, the supernormal profits are achieved. Now, clearly, there is an argument to say that if profit is a motivator for why businesses come into a market, then if you have supernormal profits in a marketplace, then that is going to attract new competition, assuming that they haven't got particularly large barriers to entry into that particular market. So we'll look at that in a little bit more detail as we go. But those fundamental principles, the difference between normal and supernormal profit, how you calculate profit, which essentially is total revenue minus total cost, are things that you need to bear in mind. Okay, so let's take a look at the difference between an accountant's view and an economist's view of profit then. So in this instance then, if we take a look at the economist's view, we basically have total cost, which is essentially the financial cost. Now that essentially is your cost paid out, so things like rent, wages, raw materials, whatever that might be. But in addition to that, when we're talking about an economist's view, we're also considering the opportunity cost, so the cost of the opportunity that is foregone by staying in this particular market. Now, that's actually sometimes quite a difficult thing to calculate, but in terms of the total cost that economists are allowing, when they come to calculate whether a business is making normal profits or not, it's basically the financial cost plus the opportunity cost, which they're using to calculate total cost. In this scenario then, if we have a situation where our financial cost, as we've highlighted here, is at this level here, okay, and our total revenue is at a significantly lesser amount, then in that situation, if we were an accountant, because our financial cost is higher than our total revenue, we would be making a loss. If we assume, in this case, the economist, what the economist would assume is that, again, for the same reasons, total revenue is less than just the financial cost. The economist view would be that that would be a loss, but we would be making a subnormal profit. Okay, it's another term for a loss essentially, but subnormal profit meaning that obviously it's below the normal profit, and in that scenario we would actually be making a loss. Let's take a look at the next example then. So in this situation, if we have total revenue that is equaling total cost, so there we go. So in this case, our financial cost, okay, an accountant will look at the financial cost, so that's variable costs plus fixed costs, and then it will compare, or an accountant will compare that with total revenue, where total revenue equals total cost. The accountant's view is that the business has actually achieved break even, where total revenue equals total cost. The accountant's view is actually that is still a loss, i.e. a subnormal profit, because although the financial costs are covered by the total revenue and they're equal, then the opportunity cost in this case, the economist's view is that has not been achieved, so we are still in a position where we're making subnormal profits. Okay, subnormal profits meaning essentially losses. Let's take a look at the next example then. In this instance, we've got financial cost again at the same level, but in this instance, we have total revenue, which is significantly higher than just the financial cost. And from an accountant standpoint, that would actually then mean that profit was being achieved. If we take the view of the economist, where we're assuming financial cost plus opportunity cost is the point at which we make normal profits, we are still in a loss position, and we are making subnormal profits. Now, if we look at the next example, where in this case our total revenue is going to equal our financial cost plus our opportunity cost, as far as an accountant is concerned, that is a significant amount of profit being made. And in this instance, you can see that total cost and opportunity cost are around about the same. So effectively, they would be making, as an accountant, from the accountant's viewpoint, you would be making a significant amount of profit on that particular piece of trading. If we then take a look at what the economist view would be, that would be where we're actually achieving normal profit. So effectively, all of our costs, our financial costs and our opportunity cost, are covered by the total revenue, and that would be a point at which we've achieved normal profit. If we move on to the next column, again, where we've got our total revenue at a higher level than our financial cost and our opportunity cost put together, then again, from the accountant standpoint, we are making a profit because we've covered our financial costs, and anything over and above that is basically profit. But as far as an economist is concerned, we are now into the realms of achieving a supernormal profit. So we've got more than normal profits because in this case, our total revenue is higher than our financial cost and our opportunity cost. Okay, now that might seem a bit odd, the way in which those differentiate themselves, but I think it's actually quite a nice explanation as to why these definitions are slightly different. So we'll move on and take a look at the next thing on the basis of profit maximisation, and also the way in which economists and accountants define these terms in a slightly different way. Okay, so let's take a look at what the difference is between normal and abnormal or supernormal profit. And we've sort of talked about that briefly, but I'm just going to go through it in a little bit more detail. So if we've got normal profit from an economist standpoint, that's basically the minimum level of profit necessary to keep firms in the market, but insufficient to attract new firms into the market. So in that situation, if we were getting loads and loads of profit, making humongous amounts of profit, that is basically going to attract new firms into the market, and the competition that is attracted will essentially almost compete away any higher level supernormal profits. Okay, so the normal profit calculated by looking at the total financial cost plus also the opportunity cost of choosing to stay in that particular market is the point at which we define normal profit. As we said there, just to sum that up, really, we treat normal profit as an opportunity cost, which they include in the firm's average cost curves as well. So total financial cost plus opportunity cost, that gives you your firm's average cost curve as far as an economist is concerned. So in the long run, firms are unable to make normal profits will choose to leave the market, because clearly they're not allocating their resources as well as they could do. They might be spending significant amounts of money trying to achieve that scenario, but in that case, they are in the long run going to leave the market if they're not able to make at least normal profits. And clearly, normal profits will vary from industry to industry, and that depends on the risks that firms are facing and the amount of competition that they face, and a whole range of other things. But it's important that you're aware that there is, normal profits do vary from one industry to another. If we take a look at abnormal or supernormal profits, then to compare the two, basically any profit over and above normal profit is known as abnormal or supernormal profit, and it's more often than not achieved by monopolists, so people in markets that have got monopoly power, so they are price makers. They can differentiate themselves. They can also choose the price that they are going to select, and effectively in that scenario, because of their dominant market power, they are likely to be able to make profits over and above the normal profit level. Okay, so it's an important distinction to understand. And obviously, if you get a situation where you're making abnormal or supernormal profits, there is a possibility that other businesses will be attracted into that market, simply because in this situation they can see that there's an opportunity for them to maybe make some of that profit too. Okay. So let's take a look then at the role of the of profit within the economy. Now there are a couple of examples that I just want to run through, which will follow this, which actually will just test your understanding on normal profits, etc. But we'll take a look at what the role of profit is within a market economy in the first instance. Okay, so in the long run, if we've got a situation where we have no barriers to entry, so that we haven't got particularly high costs to entry into a market, then any abnormal profits that are being achieved within a particular market is likely to attract new firms. Okay, so provided it's not very expensive to set up a production line, like in the car industry, as an example, if you've got a relatively straightforward process to be able to enter a market, and it's not massively expensive, then abnormal profits in a particular market will attract new firms into a business. It will act as an incentive. If people can see they might be able to make a profit, then they're going to steam in and try and do exactly that. That, if it happens, is clearly going to lead to an increase in market supply. So the very fact that if people and businesses, new firms, are able to move into a new market, that is clearly going to increase market supply. If you think about this in a competitive market, then if we've got new firms entering a market, then that is likely to trigger a process where abnormal profits are going to be reduced, prices are probably going to be reduced, and on the basis of the competition and the fact that you've got to look at what the competition is charging and make sure that you're charging a competitive rate, that is clearly going to benefit consumers, because the competition is going to mean that prices will fall and consumers are going to be getting greater welfare, greater utility from their purchase as a result, because the price of the purchase is going to fall. Now, in some cases, profit can be seen as an indicator of economic efficiency. And if you think about that, if the business is able to reduce its cost of production using economies of scale that we talked about before and achieve the most efficient production processes, then one could argue that profits are actually a really good indicator of how well you're running a business. Okay, and as we said before, that tends to be the main motivator for most businesses. But in this instance, obviously, that is quite an important indicator of economic efficiency. Clearly, in that situation as well, it can act as a massive incentive to workers, to shareholders, to entrepreneurs to work harder, to gain greater dividends, and also, in some cases, to reward risk taking, which clearly entrepreneurs do. They actually take a lot of risk in order to set up new businesses, etc. And in each instance, the profit that a business can make should create an incentive for workers, because if a business has been quite far-sighted and has got some sort of profit-related pay scheme or incentive scheme in place, then workers will benefit in that they will be incentivized to actually work even more efficiently and create more profit for the business, because they're going to get a share in that. Clearly, shareholders, main reason why shareholders buy shares is to make a dividend from the profit that the business is making, and also for the shares that they buy to increase in value. And that is only really going to be done by the business being successful and profitable. Okay, so it clearly can act as will have an incentivizing function within a particular market sector. Okay, it's also very important to bear in mind that profit that's achieved can be a very important source of finance. So in lots of cases, businesses that make a profit, in order to then grow or expand their business, they're going to use the money that they've generated from the profits that they made in previous years to invest in new projects and maybe to expand or grow the business. So the whole range of things that profit can do within a market economy. Let's take a look then at on page 54. You've got a couple of questions that I'd like you to take a look at. So we've got profit and loss practice questions. So the question number 1 is about the businesswoman who's running her own business. It's on, as I said, on page 54, and there are a couple of questions that I would like you to have a go at answering on the basis of the figures. What were the costs she actually paid out, and what were her economic costs, and did she make a profit last year? So you'll need to take a look at the information that's provided to you. It tells you a little bit about how she's been doing in the last 12 months. I won't read it all out. You can take a look at it. The question 1 case study is there for you to take a look at, and then let's have a go at answering the question. So I suggest you stop the PowerPoint here, have a read of the question, have a go at answering the questions, A and B for question 1, and then we can come back and discuss what those answers are. Okay. So welcome back. Let's just take a look then at this first question then. So question A is asking, on the basis of the figures, what were the costs she actually paid out and what were her economic costs? So let's take a look at what they are then. So the financial costs were materials and wages. The opportunity cost was the rent given up and the bank interest given up and the salary given up. And so the costs paid out in this situation, our accounting or our financial costs, were £27,000. So it's £18,000, which was the figure she paid on materials, and £9,000 she paid in wages to a worker whom she employs. Okay, so that's the costs paid out. The economic costs, though, where we've got to consider not just those costs that are paid out, but also the economic costs, so accounting cost and the opportunity cost. What we have to do in this scenario is to look at the original 27,000, and in this case, we're going to add £10,000 for rent. We're also going to allow for, in this case, the £40,000 that she's got tied up in capital, and the current rate of interest at 5%. So in this instance, and then obviously we've got the 15,000, which is the money that she could have been using for or earning via the trained teacher option that she had. Okay, so in that case, the economic costs are going to be significantly higher than just the financial costs, and that's going to total £54,000. Okay, so if we think about some of the other things that we, and in terms of what we could assume, if the parents were to let the shop themselves, if the daughter was not using it for the business, then there's a potential £10,000 of rent that could be achieved, which again would be the parent's opportunity cost, but not her own. Okay, that's just worth bearing that in mind as far as the question is concerned. Let's take a look at B then. So did she actually make a profit last year? Yes, she did. So she made £6,000 of profit, so £60,000 worth of turnover, £54,000 worth of economic costs, total costs, including accounting costs and opportunity cost. So essentially, from an economic standpoint, we're making supernormal profits, where effectively turnover, our total revenue, is higher than our normal profit level, which is essentially the paid out costs, and also, or the financial cost, and also the economic cost or the opportunity cost involved. Okay, now effectively, if we were an accountant, if you remember the chart that we were just looking at previously, in that situation we would actually be making a significantly larger amount of profit, so that the accountant would be saying that we've achieved £33,000 worth of profit. So £60,000 worth of turnover, take away the cost paid out of £27,000. Okay, so that's the first question answered. Okay, let's take a look at the and in this case, obviously, it's if we stay in our current activity, then the issue may be that firms might be attracted into the industry because of supernormal profits. Okay, let's take a look at this break-even point then, okay, in question 2. So in this instance, okay, we've got a number of different values given in terms of the level of output and total revenue, total cost and profit. So taking a look at the bottom of page 54, you've got that table that you need to take a look at, okay? And effectively, we need to look at what output is break-even and where are we making maximum profit, where are we maximizing profits. Well, in this instance, obviously what we need to take a look at is where do we actually get to the point where total revenue equals total cost to calculate break even. So in this instance, effectively we've got a situation at 3 units where our total revenue is 75, our total cost is 75. So at 3 units we're making no profit at all, i.e. we're breaking even. If we then take a look at where we're going to maximize profit, if we look at B, okay, which is the question that we're being asked to consider, in this instance, then there are a couple of options, okay? It's clearly going to be somewhere between 6 and 7 units because effectively we can see that we're making a profit of 27 in both of those cases, okay? Now, in terms of that situation, that clearly gives you an idea of how you can use break-even and also calculate maximum profits based on data that you've been given. Relatively straightforward example there, okay? But important for you to just understand the principles of what's going on as far as that's concerned. So those are 2 questions. Now, one of the things that we're going to also take a look at is, and it's a very important concept in economics, this concept of profit maximisation, which we have talked about briefly, but it's very important that you understand this because we keep coming back to it again and again and again, this principle of profit maximisation. What's it all about? Let's just go through what it is then, okay? So marginal cost basically is a concept that we need to bear in mind, okay? And remember, we have looked at marginal cost previously, and essentially what that is the additional cost of producing one additional unit of output, okay? So if we've got, clearly, if we're going to produce one extra unit, then there are going to be some costs that will be that you can allocate to that extra unit of output, okay? So when we're trying to calculate a profit maximisation point, that marginal cost is quite an important concept for us to be able to understand and explain. Now, obviously, in this instance, the way in which we can calculate our marginal cost is to look at the change in total cost and divide that change in total cost by the change in quantity. And that gives you your marginal cost. Is another way of calculating it, okay? So if we then look at marginal revenue then, okay, which again is a very important concept, both marginal cost and marginal revenue for profit maximisation are really important principles, okay? So marginal revenue is essentially the additional revenue that you generate from selling that one additional unit of output that you've produced, okay? So marginal cost is the cost of producing that one additional unit. Marginal revenue is the additional revenue that you achieve by selling that one extra unit of output. Again, we can calculate that by looking at the change in total revenue divided by the change in total quantity in order to calculate it. And let's just take a look at how this might work out, okay? So we've got those definitions clear, hopefully clear in your own mind. What I'd like you to take a look at is this simple, relatively simple table on page 55, which looks at some profit maximisation calculations. Now, in this instance, we've got output at 1, 2, 3, 4, 5, and 6, but important that you just double check, in this case, the unit. So we're talking about millions of units, okay? So the output is at 1 million, unit 2, 3, 4, 5, 6 million units, okay? Now, our total revenue has been given to us. Again, it's in millions of pounds. So in this instance, we've got 10 million pounds worth of revenue. And also, you can see that in each case, our revenue is increasing by the same factor. So it's effectively by it's doubling. It's going up by 10 million, then another 10 million, then another 10 million. That tells you something about the price that is being charged for each different item, and that might also tell you something about whether this particular company is in a price making or price taking position. Okay, now let's take a look at total cost then. Okay, so we've been given total costs. In this instance, our total cost is £8 million for output of 1 million units. It goes up to 14, 2 million units, to up to 20, 30, 50 and 80 as we get into producing significant levels of output. Okay, now what I'd like you to do is have a look and calculate the total profit, the marginal revenue, the marginal cost, and also the marginal profit. Okay, where we're essentially taking marginal revenue away from marginal cost to see if there is any marginal profit. Okay, once you've done that, I want you to have a go at plotting that information, and then we'll take a look at it and run through the whole process in a little bit more detail. Okay, so again, I suggest you stop the PowerPoint here, have a go at filling in your table on page 55, and then also plot your total figures and your marginal figures on the two sets of axes that have been provided. Okay, so I'll leave you to do that, and then we can come back and take a look and fill this whole process in. Okay, so welcome back. Let's take a look at this profit maximisation calculation then. So in the first instance, we've got 1 million units being produced, total revenue of 10 million, total cost of 8 million. So we're making a total profit in 1 million units of £2 million. If we then take a look at output at 2 million, effectively we've got 20 million turnover, take away 14 million cost, we've got £6 million worth of profit. And if we go through this process, you can see for at 3 million units, we're making £10 million worth of profit. We're also making £10 million worth of profit at 4 million units. And then we get to a situation at 5 million units where we're not making any profit at all. Total revenue equals total cost. And that is quite an important example there that we'll look at in a bit more detail. And then finally, at 6 million units, our total cost actually exceeds our total revenue by 20 million. So effectively, we're making a £20 million loss in that situation. Okay. Let's then take a look at our marginal revenue then. Okay, remember that's basically where we're looking at the cost, the revenue that's generated by the extra units of output. If we then take a look at our example here, where the marginal revenue effectively is the difference between the first set of units and the second set of units. So we're talking about marginal revenue moving from 1 million units of output to 2 million units of output of 10 million. If we then take a look at the increase in total revenue, or the change in total revenue divided by the change in total output, again we've got 10. Now in each instance you can see that the marginal revenue for each extra unit of output, or the marginal revenue in this case, to calculate it, remember, if we take the change in the total revenue and divide that by the change in total quantity, we can see our marginal revenue at each different level of output is increasing by a factor of 10. Let's have a look at how our marginal cost is changing then. Okay, so clearly marginal cost is the cost of producing the extra units, and in this instance, obviously there is no extra situation. We've produced at 1 million units. Okay, when we produce at 2 million units, effectively we've got a situation where effectively our marginal cost is at 6 million units. Okay, so effectively in this case our cost was at 8, it's gone up to 14, so the difference between the two is 6 million. The second example, again, where our total cost has gone up from 14 to 20, again we've got a marginal cost of 6. Then we get to a situation where our marginal cost has gone up significantly, in that it's gone from 20 up to 30 million, so we're talking about 10 million marginal cost. And at that point there, you can see that we're starting to get to the point where marginal revenue and marginal cost are equal. Okay, let's take a look at the scenario at 5 million units then. Okay, so our marginal cost in this case has gone up significantly, where effectively we can see that our total cost has increased by 10 million, by 20 million, taking the difference in total cost from 30 to 50 million. And then the final point at the increase between 5 million and 6 million has gone up to 30 million in terms of the marginal cost. Okay, so that's the increase in the cost, the change in total cost divided by the change in total quantity. Let's take a look at the marginal profit now then. Okay, again, for 1 million units, we haven't got a marginal profit. This situation where we're talking about marginal revenue minus marginal cost, you can see that in this case, our revenue is higher than our total cost, or sorry, our marginal cost. So our marginal profit is going to be 4. Again, same principle applies, where in this case our marginal revenue is still higher than our marginal cost, so we're still achieving that marginal profit of 4 million. Where we get to 4 million units, though, effectively our marginal revenue and our marginal cost are the same. So with our marginal profit is where we're not making any profit from that activity. So in that situation, we are clearly in a position where we are still making some revenue, but effectively our marginal profit, the difference between our marginal revenue and marginal cost is at 0. Then we get into a position where effectively our marginal cost has gone up significantly. Our marginal revenue has stayed the same. So we're into a marginal loss in this instance, where effectively we're making our costs are £10 million higher than the marginal revenue that we're achieving. And if we take a look at the last point, where effectively our marginal cost is 30 million and our marginal revenue is 10 million, we're effectively losing 20 million pounds worth of sales, essentially, or profit. Okay, so if we then take a look at the way in which we can consider this, okay, and using the data explain why marginal cost equals marginal revenue, why that is the point of profit maximisation. Effectively, for as long as we get a situation that our marginal revenue is higher than our marginal cost, if you think about it, remember, marginal revenue is basically the extra amount of revenue that you're achieving for each item that you sell. For as long as the marginal revenue is higher than the marginal cost, then a profit maximizing firm will carry on producing, because even if it's just a small amount that the marginal revenue is higher than the marginal cost, that is a small amount of profit that is being achieved on each of the extra units that you're producing. Okay, as soon as marginal revenue equals marginal cost, then that is the point at which a profit maximizing business will stop producing. Okay, that is the most efficient point at which it can produce, given that it is trying to profit maximize. Okay, it's squeezing all of the profit out of this particular activity. Okay, so let's take a look then at the next thing, where we're looking at the post profit maximization table, and in this instance, so in this question then, if we're talking about profit maximization level of output, clearly in this case we're talking about it's between 3 to 4 units where we've got a total profit of 10. The 2 levels of profit maximization output are due to the non-incremental changes in quantity. Okay, so we've got the same amount of profit maximization or profit being achieved at those between 3 and 4 million pounds. However, the true profit maximizing output would be at 4 million. Okay, where effectively our marginal cost equals our marginal revenue. Okay, it's where our marginal profit is essentially zero, okay? So as soon as we get to that point, that's the point at which a profit maximizer would actually be working. It wouldn't produce at any higher or any lower level than that, because if it were producing at a lower level, then it would mean that it's not actually getting all of the profit that it could get out of this activity. But if it was producing at a point at which marginal revenue is lower than marginal cost, then it starts to actually lose an element of profit. Okay. So, if we're talking about, in this case, why is it that marginal cost and marginal revenue being equal, why is that the point at which that would be the profit maximizing level of output? And effectively what it is, the reason for it is that where we got marginal cost equal to marginal revenue and the marginal profit is zero, and in this case, if we were producing less than 4 million units, we would have actually missed some of the marginal profit that we could have achieved. And if we were producing any more, we would start to lose make marginal losses, which clearly, again, is going to be a little bit of an issue. Okay. So let's take a look at the profit maximisation graphs then. So I know you're going to have a go at drawing these, or hopefully you've had a go at drawing those already. But let's just take a look at how these look, okay? And I'm just going to draw the two in. These are sort of stylistically produced, but it's hopefully reasonably clear from what we're talking about, what's being shown there, okay? So the first one is totals, okay? So we've got total revenue, total cost, and total profit. And then we've got the marginal. So we've got the marginal revenue, we've got the marginal cost, and we've got the marginal profit, which is basically just taking what you've calculated in your table and showing it graphically, okay? So let's just take a look at what this is telling us then. You can see in this case, if marginal revenue is actually higher than marginal cost, then marginal profits are going to be made, and so we would increase our output, okay? So for as long as marginal revenue is actually higher than marginal costs, so if we take a look at this situation there, any point here where we've got marginal revenue, before that gets to the point where marginal cost actually increases, we would carry on producing if we were a profit maximizing firm. Now, clearly, if marginal revenue was actually less than marginal cost, then we start to make marginal losses, and so we would then decrease output, okay? So as soon as we get to the point where marginal cost is higher than marginal revenue, anything above 4 million units, we would actually decrease output, because if we were a profit maximizer, we would actually be making marginal losses on anything that we produced over and above that level. Okay, so hopefully that sort of makes a little bit of sense. You should be able to see in that scenario that, again, where we've got these changes going on, again, if we take a look at our total cost, where we got total revenue and total cost, then clearly the point at which we would be wanting to produce, given what we know about marginal revenue as well, is at 4 million units. And you should be able to see that the difference between our total cost line, the line in black, and our total revenue line is at the highest amount. Okay, the gap between the two is at the highest point. Now, clearly, that obviously then demonstrates that we must have calculated that correctly, because effectively we've said that our marginal, and up until marginal revenue equals marginal cost, we as a profit maximizer would carry on producing. Okay. So next thing then, let's just take a look at this example where we've got another couple of questions to answer, and then I think we will stop. In fact, looking at that, I think we'll do these few calculations and then we'll stop, okay? So let's take a look, in this case, at the activity on page 56, where it looks at profit maximisation, showing profit maximisation on a diagram. Okay, so there are two diagrams in your book, and I want you to consider again at what points does a firm actually break even, and at what point does the business actually maximize profit. Okay, so the first things first, is this, in this situation, is our firm a price maker or a price taker? What do you think? Well, in this instance, clearly it must be a price taker because we've got the total revenue, which is at a constant gradient. Okay, so you can see this line is actually going up in a constant way, and obviously in this case our marginal revenue is also horizontal. So that's suggesting that where the marginal revenue is horizontal, that must be we must be in a price taking scenario. So we must be in some sort of perfectly competitive environment of some description, or certainly not able to influence price in this case. At which points output levels does the firm break even then? What point would be normal profit? Okay, well, in this case, it would be either B or D. So this point B or D, and that's the point at which total revenue equals total cost. So we can see at this point, total revenue and total cost are the same, and total revenue and total cost are actually the same at this point here too, okay? But if the business was going to maximize profit, then in this case, that would be the point at which marginal cost equals marginal revenue, and marginal cost was rising or total revenue was greater than total cost. Okay, so in this case, our point would be C. Okay, so at this point, so our maximizing profit point would be the point at which total cost is the furthest point away from the total revenue line. Okay. Let's take a look at this next activity, and then I think we'll take a break because this is taking a little bit longer than I was expecting, but I think it's important to make sure that we understand this principle. Okay, so activity 2, profit maximisation. We've got another graph drawn for us, and in this case, what we need to do is decide whether the firm is a price maker or a price taker. And then again, what levels of output would the firm be producing at break even, and also at maximising the profit point? Okay, so let's take a look then. Is the firm a price maker or a price taker? Let's take a look at the revenue line, and you can see that that is a variable line. Okay, so that would suggest that maybe we are the level of revenue is changing with different levels of output. So in that situation, we are actually a price maker. Okay, so our total revenue is rising, and then it falls as quantity increases. Okay, so that would be a typical example of a price maker. In terms of the point at which break-even is achieved, what particular output level, and remember when we're talking about break-even, that's where total cost and total revenue are equal. At 2 points, at Q1 and at Q5. Okay, that's the 2 points at which we are breaking even. Okay, if we're maximizing profit, though, again, this is the situation where the gap between our total revenue and total cost is at its greatest, or the gradients and tangents of the curves are the same. And so this is going to be the point at which MC equals MR. Okay, so in this case, it's at Q3, and you can see again the difference between our total cost line and our total revenue line. There is the largest gap between the two at that particular point. Okay, so that would be the point at which we were maximizing profit. Okay, so I think we're going to take a break there, and then we'll finish off the last couple of questions, and then we'll start to look at the functions of profit, and also there's a couple of questions, a couple of case studies for you to take a look at in terms of profit, etc. And we'll also then move on and cover the last part, which is to do with technological change. So thanks once again for listening. I know that was probably a little bit longer than I would have ideally liked, but I think it does cover some of those key and very important points of profit, how important profit is, and the principles of profit maximization. And we'll keep coming back to this again and again and again. It's a very important principle you need to get your heads around. Okay, so if it takes a little time to just keep looking at the narrative PowerPoints, or we need to talk about it more when we come to look at our work together in our online lessons, then clearly we can do that too. Okay, so thanks for listening, and I'll catch up with you soon. Thanks.